Imagine if I told you that you could own a small piece of companies like Apple, Google, or Tesla. Sounds impossible? Well, that's exactly what the stock market allows you to do. But here's the problem. Most people think the stock market is gambling. Others think it's only for rich people. And many avoid it because they simply don't understand how it works. So, in this video, I'm going to explain the stock market in the simplest way possible. What is the stock market? Let's start with the basics. The stock market is a place where people buy and sell ownership in companies. That ownership is called a stock or share. Think of it this way. Imagine you start a business that's worth 100,000. You decide to divide your company into 100,000 pieces. Each piece represents a small ownership stake in your business. These pieces are called shares. If someone buys a share, they become a partial owner of your company. That's exactly how the stock market works. Instead of buying an entire company, investors buy small pieces of it. Why do companies sell shares? Now you might be wondering, why would a company sell ownership in itself? The answer is simple: to raise money. Let's say a company wants to build new factories, create new products, expand into new countries. All of this requires money. Instead of borrowing money from banks, the company can sell shares to the public. People buy those shares. The company gets cash, and investors get ownership. It's a win-win situation. How do investors make money? There are two main ways investors make money in the stock market. Number one, stock price growth. Let's say you buy a share for $100. Over time, the company grows and becomes more valuable. Now, that share is worth $150. If you sell it, you've made a $50 profit. Simple. Number two, dividends. Some companies share a portion of their profits with investors. These payments are called dividends. For example, if you own shares in a company that pays dividends, you can earn money simply for being an owner. It's like getting paid for holding the stock. Why do stock prices go up and down? Stock prices move because of supply and demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell than buy, the price goes down. But what affects demand? Things like company profits, new products, economic conditions, interest rates, investor emotions. And here's something important. In the short term, stock prices can be very emotional. But in the long term, strong companies tend to grow. Is the stock market gambling? A lot of people think the stock market is gambling. But that's not entirely true. Gambling depends mostly on luck. Investing is based on research, patience, and long-term thinking. Now, if someone buys random stocks hoping to get rich overnight, that's very similar to gambling. But if someone invests in strong businesses for many years, that's investing. The biggest mistake beginners make is trying to get rich quickly. The stock market rewards patience, not impatience. The stock market has created countless millionaires over the last century. Not because they were lucky, but because they understood one simple principle: own assets. When you own shares in great companies, you participate in their growth. And over time, that growth can completely transform your financial future. So now you know what the stock market is and how it works. If you learned something new today, hit the like button and subscribe for more videos on money, investing, and financial freedom. And remember, don't work only for money. Learn how to make money work for you.